Welcome to The Explainer. Today, we're diving into a genuinely fascinating financial parallel. We're going to look at how the exact same traps that can quietly drain your personal wallet are right now threatening multi-billion-dollar skyscrapers. Because honestly, whether you're trying to balance a household budget or manage an entire city's skyline, the ruthless laws of debt and cash flow remain exactly the same. Let's get right into it. Here's our roadmap for today. We're kicking things off with the middle class trap and then looking at a roadmap to financial freedom. From there, we'll scale way up to the commercial maturity wall, pull some lessons from recent hard maturities, unpack this wild concept of stealth delinquency and recidivism, and finally, we're going to brace ourselves for 2026. Starting off with Section 1, the middle class trap, and how prioritizing comforts can get us into trouble. The fundamental question we really have to ask ourselves, and financial educators like UDirect IRA Services hit on this a lot, is whether we are prioritizing short-term stability while quietly taking on excessive liabilities. You know how it goes. It's incredibly easy to get comfortable. You get a raise, so hey, you buy a nicer car. You snag a bonus. You book a lavish vacation. But it's exactly this pursuit of immediate comfort that builds the trap, subtly trading away your long-term growth for just a little short-term gratification. Escaping this trap requires completely rewiring your brain. Seriously. As long as you have a consumer mindset, funneling your hard-earned money into depreciating assets, you are literally building yourself a cage of liabilities. The root of the trap is lifestyle inflation. When your expenses just rise in lockstep with your income, you have absolutely nothing left over to invest in wealth-building assets. It's that simple. Moving on to Section 2, financial freedom and how to actually escape that trap. Now, what's really interesting here is how straightforward the playbook actually is to break those chains. The UDirect IRA roadmap highlights a few key sequential steps. You shift your mindset, diversify your income streams, actually live below your means, and this is the big one, leverage good debt. Notice it doesn't say avoid all debt. That distinction is literally everything. Debt is a tool, and when you use it strategically, it becomes the ultimate lever for building real wealth. Everyday investors can totally use this good debt to acquire income-generating assets. Take house hacking, for example. It's a prime strategy. You buy a duplex, live in one half, and rent out the other. The cash flow generated by your tenant pays for the debt you took on to acquire the property in the first place. The asset literally covers its own liabilities, effectively breaking you out of the trap. Let's hit Section 3, the commercial maturity wall, where we take these concepts and scale up the debt. Okay, so what happens when we take that exact concept of leverage and multiply it by billions across entire city skylines? Over the past few years in the commercial mortgage-backed securities market, a massive maturity wall has been looming. We're talking about a tsunami of loans that were originated back in a low-rate era, and they are now crashing headfirst into a high-rate reality. It is a highly complex landscape of massive debt, all coming due all at once. In this world, you run into what's called a hard maturity. Think of a hard maturity as a literal financial brick wall. The loan is up, there are absolutely no pre-baked extensions and zero safety nets. The borrower can't just walk away. They are forced into a high-stakes negotiation room with their lender. According to the TREP CMBS playbook, hard maturities strip away all the market noise and give us a true, unfiltered stress test. And here is where it all connects. Just like you need to live below your means to afford a personal mortgage, commercial properties rely on a high debt yield to prove they're a safe bet for refinancing. Debt yield is essentially just the property's strong cash flow relative to its massive debt burden. If a commercial property doesn't have a high enough debt yield, lenders simply will not refinance it. It's the exact same cash flow to debt principle as the middle class trap we talked about, just scaled up with a whole lot more zeros. Section 4, lessons learned from those hard maturities. Let's dive into the TREP data to see how borrowers actually handled these walls in 2024 and 2025. While 2025 looked cleaner on the surface with a 70% on-time payoff rate, both years left behind a deeply toxic residue of unresolved debt. I mean, think about that bottom row for a second. Unresolved loans in 2024 spent an average of 66% of their post-maturity life in a non-performing state. Those are the squeaky wheels generating all those doom and gloom headlines across the commercial real estate sector. Focusing right on 2024, the sheer weight of that $12.3 billion in unresolved debt is just staggering. That middle chunk represents billions of dollars trapped in a space where the property's cash flow simply could not satisfy the lender's strict requirements to secure a new loan. They hit the wall, and they couldn't climb over it. When we drill down, the 2014 vintage created the sheer volume of the wall, for sure. But the 2019 vintage loans, they were the true delinquency engines. A drop from a 9.0 to an 8.2 debt yield might sound tiny to us, but in commercial real estate, it is the difference between breathing room and total suffocation. Nearly half of the 2019 vintage couldn't pay off. They were caught in the commercial version of the middle-class trap, totally unable to support their own lifestyle. Moving on to Section 5, Stealth Delinquency and Recidivism. So what actually happens to these unresolved loans? Well, they don't just sit quietly in the background. They become zombie loans. They engage in this massive tug-of-war called maturity recidivism, basically bouncing back and forth between paying and defaulting while the parties desperately try to negotiate an exit. A loan might go delinquent after maturity, magically cure back to current as a performing balloon, and then fall right back behind again. It's a highly volatile dynamic that deeply aggravates overall market stress. And this creates what we call stealth delinquency, because total volume alone doesn't actually predict stress. Sometimes a handful of massive, non-performing loans can severely warp the headline rates, acting like a toxic core hidden deep inside a pile of otherwise totally healthy files. Some loans might technically not pay off, yet they perform perfectly while negotiating. Others that eventually do pay off might have spent 100% of their post-maturity time in total default. It's wild. Finally, Section 6, Bracing for 2026 and the Ultimate Trap. Prepare yourselves for this one. The hard maturity wall for 2026 isn't just large, it is a staggering $76.6 billion. It completely dwarfs the hurdles we saw in 2024 and 2025, and it's setting up a truly unprecedented test for the commercial real estate market. The impending danger here isn't just the sheer volume, it's the timing and the quality of the loans. This debt is heavily backloaded into Q4, and over a third of these loans are sitting at a dangerously low debt yield of 8% or lower. Remember that 2019 vintage we talked about? Well, in 2026, we have $27.3 billion sitting in that exact same danger zone. That is a whole lot of properties whose cash flow simply cannot cover their debt reality. Whether you're managing a personal rental property or a billion-dollar office tower, the fundamental rule remains exactly the same. If your cash flow can't cover your debt, you are in the trap. The mechanics of debt, they do not care how many zeros are at the end of your balance sheet. So, as we look ahead to this totally unprecedented wall of commercial debt, we have to ask, has the market actually learned to live below its means? Keep your eyes on those debt yields as we roll into late 2026, because the ultimate financial trap may still be waiting to spring. Thanks for joining me on this explainer, and I'll catch you next time.